think we have decadence. I think we're on the other side of the looking glass where we have fiscal dominance and this kind of like literal death spiral. A slow motion fiscal train wreck that's playing out. It's very hard for the Fed to tighten when public debt is this high and when any tightening they do adds to so much interest expense, which ironically is stimulative. It's fiscal deficits pouring into the economy. It's very hard to have a recession when you're running $2 trillion deficits. You're pre-stimulating before the recession even arrives. And of course that comes with consequences. We risk having a second inflation wave. We risk furthering asset prices going up faster than wages, keeping people locked out of the housing market, locked out of the stock market.
Will I have a pension?
To some extent, those systems are Ponzi-like.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexej, Jordanov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with some money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Welcome, Lyn.
Happy to be here again.
You know what's great? The best part is when you just listen and see people online and you're just watching and hearing them, and the best part is meeting them. And you're one of the people that I enjoyed most meeting actually in person.
I appreciate that. It's been great meeting you too. We shared a taxi at one point.
Yeah, exactly.
It's kind of a hectic taxi situation here, and it's great to see.
Yeah. So, Lyn, we're at the Bitcoin Atlantis. Today is the 3rd of March, just to be transparent for also the viewers and listeners, because this might be published in a few weeks. And obviously the theme of Atlantis, and I've mentioned this now in a couple of interviews beforehand, is the myth around what Pluto wrote thousands of years ago of something that we're not sure existed or didn't, but that doesn't really matter, about a city that was built upon a utopia, had an abundance of gold, silver, resources, and was dominating the seas. And at some point, it was considered like being a half god, half human society because of its prestige. And because it angered the gods to some reason, but not just only, but it obviously it went below sea and got flooded. But there was a whole period of decadence, of basically debauchery, and where morals were just all of that corruption and so on. And it kind of made me think about our system and the parallels there that we have today with that. Where do you see the constellation of what we have in the monetary system today?
Yeah, I think we have decadence. I think that's a good word choice. I mean, in the United States, we have our political leaders day trading the stock market while they have privileged access to information. There's a funny thing how politics works. So if you're a civil servant in the federal government, you're not allowed to own stocks related to your business. So for example, if you work at the Federal Aviation Administration, you can't own airline stocks because you can have all sorts of insider information. But the people at the top of the stack in Congress, they can trade whatever they want, as long as they disclose it. And so a lot of them just day trade. They beat the best hedge funds on the side while trying to govern the country because they're able to do so with privileged information. And I think that's kind of an example of kind of late stage Atlantis type behavior, as the way you described it, kind of like the decadent kind of end stage of how things go. I think basically money's been so removed from things and so in the control of people to print and debase and arbitrage. Basically, it's 40 years of rewarding arbitrage, shorting one currency and buying some asset with it, shorting a currency and buying another currency. It really kind of emphasizes and rewards those that are close to the source of capital and that have the access to have this kind of whole play set in front of them, 160 different currencies, tons of different assets. You can arbitrage between them, and it hasn't really rewarded work to the same way. And I think that's kind of the era we're in, but I think that's starting to come to a head, and now there are solutions to potentially bring those back closer together, which is, I think, a healthier state of affairs.
Mm-hmm. Yeah, Nancy Pelosi is just winging it. I mean, if you really want to follow an influencer and just see some inspiration in stocks, you just see what she discloses every quarter.
Yeah.
And it's this account I'm following, Quiver, and he just literally tracks every politician in Congress and what their trades are, and they all outperform the market. That's just it's so blatant in your face that either you can cry or laugh very hard about it.
A little bit of both, I think.
Yeah, a little bit of both. If I look a bit of with my primitive mind in finance and my understanding of the monetary system, I have a hard time understanding where we are right now. It's a bit confusing because we had tightening where central banks and especially the Fed hiked interest rates up to 5%. And at the beginning of the year of 23, we were talking about the biggest expected recession, blah, blah, blah. And now we're talking about everyone is expecting a soft landing. And we have gold that usually doesn't do well in high interest rates. And I think you have also debunked that it's not always correlated to high interest rates. And we have also Bitcoin making a big comeback. But then there's I can't associate the fact that we still have high interest rates and a bull market. So it means that if we start losing the tightening, we might expect an even bigger bull run.
So I think the short answer is fiscal dominance.
Okay.
People debate between a hard landing or a soft landing. I like to describe it as an emerging market landing. If you see how recessions go in emerging markets, often stocks are nominally up, because the currency is so weak. And it's a very different type of, when the economy is kind of interesting there, it's different than kind of the deflationary developed market economy. And what we're seeing now is some of the developed countries are approximating what happens in developing countries on a more regular basis. And that's because so much public debt has built up on the ledger. And so if you go back, for example, to the 1970s, there's two major sources of money creation. One is bank lending, so fractional reserve bank lending, and the other one is large monetized fiscal deficits. And back in the 70s and 80s, for example, the rate of bank lending was very high because the baby boomers in the United States were entering their home buying years, and there's a lot of credit creation. And so there's a higher than normal amount of lending. And there were deficits as well, but the lending component was much bigger. The year-over-year money supply increase from lending outpaced the deficit. Mm-hmm. And public debt was very low. It was 30% public debt as a percentage of GDP. And so when they wanted to slow down inflation, their policy was to raise rates super high because that slowed down the rate of bank lending. And although it did increase the public interest expense as well, that was a smaller factor because the debt level was so low. So it held down private sector stuff more than it kind of led to government inflation. And so that was successful. I guess the dark side of it is also they crushed a lot of emerging markets that had dollar denominated debt, especially Latin America at that time. And so they reduced their oil consumption by basically causing a depression, which alleviated the oil price for other places, including the United States. So that's kind of the dark side. But a couple of things have built up over those decades. So one, public debt is now 120% of GDP in the United States compared to 30%. So it's 4 times higher. The other factor relating to that second one about, say, Latin America is that the United States has run decades of consecutive trade deficits. And the rest of the world takes those deficits, and for them it's surplus, and they reinvest those into U.S. assets. So if the dollar spikes and it increases the power of their dollar-denominated debt, a lot of countries have a lot of assets that they can sell to, protect themselves from that. Mm-hmm. And so the ricochet hits the U.S. market a lot more readily than it did 40 years ago. And so now we're in a stage of fiscal dominance, which is the annual deficit that happens is larger than the sum of all bank lending. And even the sum of bank lending plus new corporate bond issuance, right? And so if you increase interest rates in a similar way they did in the 70s and 80s, if you try to increase interest rates to slow down inflation, ironically, although you do slow down bank lending somewhat, you increase the deficit by a larger amount than how much you've reduced bank lending. And that means that the central bank effectively runs out of tools to address inflation. They may be able to address it for a short period of time, but then it starts catching up with them. And I think that's what they're in now. They're finding that their tools are not as effective, and that higher interest rates are in some ways risk being pro-inflationary, because for all those interest expense that the government's paying, there are people on the other side of it that are receiving it and able to spend that into the economy. And so I think we're on the other side of the looking glass, where we have fiscal dominance and this kind of a more like literal debt spiral. It's not as quickly or as high magnitude as you see in an emerging market, but it's directionally similar. It's kind of a slow motion fiscal train wreck that's playing out. And that generally means that nominal prices are going to be higher than you expect. Nominal GDP growth is higher than you expect. And crashes, instead of prices always crashing down, the currency's slowly crashing up. So they're kind of meeting halfway. Some assets, if they get in a bubble, they consolidate, they go off. But also the currency's rising so much that you have to be very mindful of the denominator you're thinking of these assets in.
In this system, because it's funny, because I like when I was in the plane, I saw boomers and retired people and Bitcoiners, and it's like all to come here. Yeah. And in my hotel, I just see retired people all over, mainly German and British people.
Yeah.
And I'm looking at them and I'm thinking, they're enjoying their retirement. They probably had a nice pension. And then I'm thinking, because we talk about the future and all that, will I have a pension? Will I have a retirement plan? How will that be? How will that look like? Because hearing all that, I feel like, no, that's probably not going to be the case, or at least not the way the ones that are enjoying it today.
Yeah, I think, to some extent, those systems are Ponzi-like. They were calculated with kind of steadily population growth in mind, but population growth is slowing down. And so the rate of workers to retirees is shrinking. And also, when, I'm less familiar with all of Europe's different retirement systems, but in the United States, when Social Security was made, the retirement age was roughly equal to the average lifespan. Whereas now the lifespan has increased a lot faster than the retirement age. And so, instead of 40 years of work kind of covering your handful of later years, your 40 years of work are supposed to cover 20 or 30 years of like post-retirement life in many cases. And they just didn't necessarily pay enough into that to kind of get out of that. And so in the United States, Social Security's, for decades, they kind of paid more into it. But now that we're on the later part, where there's people retiring and consuming at a faster rate than new money's coming in, the whole trust fund is expected to decrease to zero by around 2034, 2035. Depends on a couple variables. And at that point, any unless they do tax increases or cuts or just print the money, that their payouts are going to get cut by like a third. And so, I don't necessarily expect to receive any sort of assistance, or if I do, it'd be very small compared to what people are receiving now. And so any retirement saving I have has to be on me, while I'm also paying for other people. And I think that in many countries, they'll face a similar thing. Some countries have managed that better than others. I think in the United States, because we have the world of reserve currency, we've kind of abused that privilege. So we're kind of, I think, pushing it a little harder than some European countries are in terms of the size of our fiscal deficits and the reticence to cut any of them.
Pension funds are also big players, right? They have deep pockets. They're like one of those, being part of those huge institutions that we were talking about. That everybody's talking about when we're talking, especially in the case of Bitcoin, of institutional adoption. And if I'm not mistaken, most of those pension funds, they are relying on bonds and treasuries. And if we look at that, it's pretty clear that the bond market is suffering, that the 60-40 portfolio is not really what it used to be, and that the coming years, the bonds in general, especially if we're talking about sovereign crisis, which we covered in the last interview, that system will fail. And I know that Al, for example, when he was managing his portfolio, he's from the bond market, and he said, well, I was obliged to buy bonds, and I would be losing a few percent on billions, and I was obliged to do so. So do you think in the long term, like, their model will shift in terms of the way they allocate money? And if so, what will that be?
I think over time, I think that, as better savings assets come out, I think the bond market's going to be viewed as less and less solvent. And that it's, the solvency is basically backed up by the ability to print money. And so, for example, in the EU, there are periods of time where, they're trying to not do as much QE, but they still have some countries that have a sovereign debt crisis. So, for example, they'll be buying Italian bonds and selling German bonds to try to even that out. And that's a recipe for political division that can cause all sorts of issues. But I think eventually all countries are kind of trending in that direction, where Japan and Italy and to some extent the United States are in, where the debt is so high, they need constant or reoccurring central bank support for their own bonds. And so you're printing money to pay your own debt interest. And so any holder of the currency or the bonds is either slowly or in some cases quickly getting diluted. So it's not necessarily that they have like a big deflationary blow up and then one day they just stop working, but instead it's just like over time, years and decades, I think we get to the point where their payouts don't buy you as much as they used to, right? They still might meet all of their nominal obligations, but those nominal obligations might not buy you as much house, might not buy you as much gasoline, might not anything that's relatively scarce and energy intensive is I think going to not be bought as much with those pension types of payouts. We live in a world where there's tech deflation, so we get better at making things and making information and making gadgets and things like that. Semiconductors get better, electronics get better, software gets better. That drives down the cost of a lot of things and offsets some of the monetary inflation that happens, but that does not really apply to things like Bitcoin, gold, houses, art, energy for the most part. The more scarce or energy intensive or labor intensive something is, that tends to go up in price pretty rapidly when monetary inflation is happening. And bonds have not really kept pace with that for a while. They've only kept pace with those more deflationary categories or the average of the deflationary categories and the inflationary categories. And I think that it's really only going to get worse in the coming couple decades.
The assets that people hold the most are houses and their own real estate, their home.
Yeah.
And especially so when they grow older, right? That portion is diminishing, right? Because it's less affordable than before.
Yeah.
To be able to, like for me, I can't afford buying a house with the current interest rates and just the price appreciation of houses. And there was a question of a friend of mine that I asked him, like, hey, do you wanna ask a question to Lyn? He said, yeah, sure. And it was about pension. And he asked a question, Lo, if that point comes where pensions can't make ends meet for people who have a pension plan, the payment is diminishing, and thereby they're forced to sell the house and the real estate to make ends meet. Will that then even more increase that? And we talk real estate is one of the biggest asset classes out there, right?
Yeah, arguably the biggest.
Yeah. That's everybody can actually own. Would that then be like an exacerbation of then the inflationary pressures that we already are witnessing? So
potentially, one thing that we're seeing in the US is that a larger share of houses are owned by big investment companies. And so the median person is less and less able to afford a house. And instead, like BlackRock will own quite a bit of houses, or even foreign investors will come through these domestic investors and own quite a bit of those houses. So there are buyers, basically people that are on the right side of the money printing, are generally able to buy those houses. I think what it essentially does is it exacerbates wealth concentration. Because it's like that gap between, if you got into real estate and you sorted the currency with a loan to get it, and especially if you're a large entity with really good access to capital, you're on the right side of all that appreciation. Whereas if you came later and you're kind of locked out of that, that's the wrong side to be on, and that's the part that gap's going to probably keep growing for a long period of time. There are obviously tools like Bitcoin or things like that to maybe catch up, but I think over time it's, from a saver's perspective, I think housing, especially in these bubbly areas, risks being somewhat demonetized. So when money is weak, when interest rates are zero or inflation's high, they kind of manifest themselves in different ways. So in developed countries, it's often because interest rates are basically zero. In developing countries, they might have positive rates, but inflation's even higher. People store their wealth in something more solid. It could be gold. It could be real estate. And the problem is they drive up the prices of utility things like real estate. They don't know what else to invest in, so they just invest in real estate. In the United States, we often invest in stocks. We often invest in the S&P 500. Instead of paying 15 times earnings for good companies, we'll pay 25 times earnings for good companies because we don't know where else to put the capital. We don't want to hold it in, especially when bonds are barely keeping up with inflation, let alone like genuine inflation. Nobody really wants to hold them. And so they kind of pour into stocks. And the problem is that if a harder money environment ever returns, either because they're dealing with a fiscal crisis and they're trying to raise rates and they're trying to kind of pull that in, it threatens some of those asset prices. And, and I think that a lot of people that are over invested in those categories in very bubbly jurisdictions, Canada's got a very expensive housing market. Australia's got a very expensive housing market. Parts of Europe have very expensive housing markets. I think those are substantially a risk. Maybe they don't crash, but maybe they go sideways for 10 years, even as inflation keeps happening. So I think those are fairly risky investments.
What do you do then? Like you talked about gold. Bitcoin obviously is definitely part of that equation as well. How would you build a future-proof pension plan by yourself?
So when we think of like the 60-40 portfolio, it's mostly assets like stocks and bonds that prefer disinflation. They prefer cheap commodities, low CPI, low interest rates. That's how their valuations get high. If you go through a period of inflation or more rapid currency debasement, I think you want to add to that a hedge of real assets, things like energy exposure, infrastructure exposure, gold, Bitcoin, these kind of scarcer assets that can't be printed, for example. I think those are the best defense we have against what's happening. In the prior cycle, the tech monopolies have kind of been the best thing to own, things that, are hard to replicate. And going forward, a lot of them are now, multi-trillion-dollar assets. Their upside is still probably somewhat limited compared to where it was 5 or 10 years ago. And I think so going forward, the asset that I still see has a lot of promise is Bitcoin. But I would never put all my eggs in one basket. So it's basically anything that has scarcity to it and that is not already very crowded in terms of the amount of capital that can be in there. So for example, the big US tech stocks, they're very crowded. Americans have a lot of exposure. Europeans have a lot of exposure to the US tech stocks. Kind of the whole world is pretty heavily focused in those. Whereas the areas that they're not in are things like energy producers or even Bitcoin. It has like a bull run right now, but it's still a tiny percentage of global assets compared to, I think, what its total addressable market it is. So I look at what is scarce and what is not over-owned. And at least, I might not want to be all in those assets, but I want to make sure that they're added to a portfolio that otherwise consists of traditional assets and maybe overweight those types of assets.
You want to be all in?
I'm never all in. I'm always somewhat diversified, but
all in Alden.
All in. My version of all in is owning much larger allocations, something that I normally would do because I'm very convicted on it.
Sorry, I just like to make puns, and there was one of them. It's easier to do in person, actually. Yeah. Probably online, you'll be like, okay. So actually, you recently put out a newsletter, as you do every month, and they're always like very informative. And this one was about Bitcoin. And more specifically, I think it was assessing the health of Bitcoin. And we're the Bitcoin Atlantis. And you've mentioned a few things already. And one of the things that occurred to me when I was And we're talking about price now. When I was in taxi, I just love talking to them and seeing like what they think about a couple of things. And obviously, I just mentioned Bitcoin a couple of times, and they said, "So, are you? Do you own Bitcoin?" Most times, no. And then I asked them like, "Could you maybe want to consider buying Bitcoin?" And they said, "No, it's too expensive." And you hear that all the time, right? 60,000 something. It's too much. And what you said during one of the panels was, I think, was brilliant, because that's exactly how it is. Is that people do not get the full scope of. And then when you mentioned the logarithmic chart, and you see basically like, okay, the highs are higher than the highs and higher than the lows. And if you look at the big picture, well, there might be hardship for a few years, but usually, on average, Bitcoin outperforms pretty much any other asset. And it does have volatility, but like any new asset class, any new technology has volatility, and volatility is good. You should have volatility. If anything, and I forgot who said that, I think it was James Lavish, you want to have volatility in a new asset class. It's a good sign, because I guess it's about price discovery and so on and so forth. Yeah. So maybe you want to share about like your views about, okay, what is the meaning and how should we perceive price in relation to Bitcoin?
Right. So yeah, to summarize, Bitcoin is globally portable, censorship resistant, self-custodial money. At least if you have the option to self-custody it. And even compared to other cryptocurrencies, it's the biggest, most liquid, most secure one. So if you want to send $1 billion, overseas, Bitcoin's the one that can handle that kind of volume. And then there's network effects associated with that. The bigger it is, the more liquid it is, the more secure it becomes, which then makes people want to own it even more. And so price is an important indicator of adoption. It doesn't matter what happens on a 1, 2, 3 year basis, but certainly over, say, rolling 4-year periods, you want to see higher highs and higher lows in Bitcoin, because that shows that adoption is happening. And like you said, volatility is important, because what you want when an asset is small is you want upside volatility. You can't go from Bitcoin currently is worth about $1 trillion market cap, a little bit above that. And it went from 0 to $1 trillion in, something like the first 12 years it hit $1 trillion, then it was in a bear market. So now it's back to $1 trillion. You can't get that without upside volatility. And with upside volatility comes leverage and comes over-enthusement for a period of time. And that's what creates periods of downside volatility. So it can't get to whatever its total addressable market is without both directions of volatility. Now, once Bitcoin gets closer to whatever its total addressable market is, so for example, you think, what percentage of your liquid net worth do you want in a portable, like a globally portable, self-custodial, peer-to-peer money, like the best one? Probably a pretty significant percentage of like a liquid net worth. And right now, very small percentage of people even own any. The people that own some usually have a small percentage. And so I think it's still climbing in terms of its total adoption. I think eventually it's a multi-trillion-dollar network. I think it'll be bigger than any individual stock. And so until it's at that kind of higher mature phase, I think the volatility is going to be present. And as far as the overall Bitcoin, kind of the health of the Bitcoin network, one of the biggest ways I measure it, one is price and liquidity, but also it's kind of the network effect of the people involved. So all the different hubs that pop up. One of the first ones was Bitcoin Beach in El Salvador, and they eventually inspired the whole nation to kind of adopt it, or at least at the president level, and kind of slowly put it out to the rest of the country. Then we've seen, for example, Bitcoin Jungle in Costa Rica, Bitcoin Ikasi in South Africa. There's all these different hubs popping up, and we're in a hub right now, which is Bitcoin Atlantis. It's a good name because you're in an island, Madeira,
I love it,
in the middle of the Atlantic Ocean. But what happened was a few years ago, a bunch of Bitcoin enthusiasts really kind of focused on this jurisdiction and said, let's create a little bit of a Bitcoin density here. That's what we're seeing play out now. That now, compared to a few years ago, from people that have been here during that time, a lot more merchants accept it. A lot more people hold it than they did a few years ago. And that's what you see in these different little hubs around the world. And so I think that as these hubs grow, that's healthy for the Bitcoin network. You don't want all the Bitcoins to be in one big BlackRock ETF. You want to see the Bitcoins kind of spread around all these different jurisdictions, all these different countries. The thing that kind of makes me most optimistic is when I go to these conferences I was talking to a woman from Saudi Arabia. I was talking to a man from Bolivia, another man from Colombia. There's a whole group from Bulgaria, someone from Australia, someone from Malaysia, a bunch of people, of course, from the U.S. and every part of Europe. Many people from Africa, people from the Middle East, and just everyone's here kind of in the same sort of shared vision. And then a lot of them go back and they're building stuff at home. They're building communities, they're building companies, and that's part of the network effect. That's part of what makes it eventually get up there as being one of the biggest monetary systems in the world.
Yeah, also the reason why people go into Bitcoin is also various. It's multifaceted. It's just as Bitcoin is, right? It has like so many components that makes it work on so many disciplines. Everyone from their own discipline can bring shed light on what it means to them as well. And so in the rest of the report, you also talk about the network effect that keeps increasing as well, and the fact that in general, like there's this correlation of also the money supply, and obviously now like where we experience some tightening where the money supply decreases, and thereby also Bitcoin decreases, but didn't decrease as much as we would expect it would, right?
Yeah.
And how is that decoupling? Is that the decoupling, or how would you explain that?
I think it's partially decoupling, but I also think that, I mean, we've seen this with gold as well. It held up a lot better than you'd expect based on the positive real interest rates and the shrinkage of the balance sheet. I think basically a lot of things behaved as you'd expect in 2022. That's when net liquidity was falling quite a bit. Asset prices across the board were pretty much falling. But what started to happen towards the end of that year and into 2023 is that even though the Fed was trying to be tight, they were no longer being as tight as they expected because of the fiscal dominance we just talked about. Money was coming out of the reverse repo facility and back into the broad money supply, even though they're trying to be tight. And so most measures of liquidity have been up since then, even though they've continued holding interest rates high and they've continued reducing their own balance sheet. Other measures of liquidity are coming in. And so you see stocks up, you see Bitcoin up, you see gold, still like holding its own. Real estate, it corrected a little bit and is back up to its highs in the United States on average, at least outside of the bubbly cities. Like you look at the nationwide average, it's kind of back up to the highs. And I think that's in large part because it's very hard for the Fed to tighten when public debt is this high, and when any tightening they do adds to so much interest expense, which ironically is stimulative. It's fiscal deficits pouring into the economy. It's very hard to have a recession when you're running $2 trillion deficits. You're pre-stimulating before the recession even arrives. And of course, that comes with consequences. That, we risk having a second inflation wave. We risk furthering, asset prices going up faster than wages, keeping people locked out of the housing market, locked out of, the stock market. And so I think that that's still a thing that it's going through, but I think more and more institutions and large entities are kind of realizing the long-term fiscal problem, and they're saying, I'm not going to hold Bitcoin just as a zero interest rate play. I'm going to hold it because I don't see any way that the U.S. government's not going to inflate their way out of this. And so you see people holding Bitcoin and buying Bitcoin despite the fact that interest rates are over 5%.
So it's so obvious, basically. That's what I guess you're saying. It's obvious. I think it's the only way.
Yeah, I think that things, if you were to describe it 5 years ago, and I did, you didn't see more skepticism. Like, oh no, they'll figure it out, but now when we're kind of at this later, more advanced stage, it's becoming more talked about in institutional circles that there's a real fiscal problem happening at the federal level and in some other countries as well. And so there's an appreciation for some of these harder assets.
And what I thought was interesting was the fact that Vanguard just fired its own CEO after 35 years of service, I think.
He's leaving. I haven't looked into the details of what the official statements
but it's just timing wise a bit funny, I find.
So for Vanguard, it's funny because like the CEO said, we're not going to allow our clients to buy it, and then he's he's leaving the company, and of course people can make the connection in the memes, and who knows if they're really related, but I do. So Vanguard's history, they're all in on the 60-40 portfolio concept. They're all in on passive stocks, passive bonds. They've been very anti-commodity, anti-gold. And now they kind of put Bitcoin in the same category, and they say that these are just not things we want to offer to our clients in any meaningful way. And so some people rotated out of Vanguard. They went elsewhere. But that's, of course, a small percentage of the trillions of dollars that Vanguard has under management. I think it really won't sting for Vanguard until Bitcoin is, say, 10x bigger than here. Maybe it takes a couple more cycles to get there. But if they kind of just miss out on $10 trillion of wealth creation that they and their entire client base were not exposed to, that would hit hard. I mean, 10 years ago today, I saw a tweet. Buffett was asked about Bitcoin and criticized it, and it's been the best performing asset since then. The only thing roughly on par with it is like Nvidia on the same sort of scale.
Yeah.
And he just completely dismissed it, and it outperformed anything he invested in.
Yeah, because it's also his world, right? And he's only able, and there's a common say in investment, right? It's only invest in what you understand.
Yeah.
And that's what he's said himself, actually, I think.
Yeah.
Right? I'm quoting it from him. And he's sticking to that.
True, but a smarter way so people are often careful to talk about what they don't know. So for example, for many tech stocks, he'd say, look, it's just outside of my scope. I'm not going to invest in it. He wouldn't trash talk the asset. Whereas with Bitcoin, he'll criticize it, objectively call it a bad investment. Like he's saying it's not just me. He's saying that is a bad asset. It's a toxic asset. It's rat poison squared. So he's claiming to understand it and being wrong for a decade.
Maybe because he just FOMO'd into that.
Yeah, so it's funny. His father was into gold. And Buffett's investing career lined up in an era where just owning stocks was the way to go for a very long time. His business partner, Munger, was also very critical of Bitcoin. And it's funny because I think it's because he actually understands it. He would rarely describe it as a bad investment. Instead, he would describe it as evil. He would view it as a disruption to central banks. But he's on the other side. He wants central banks. He does not want.
He's at the proximity of the cantillon, the tap. Yeah. He's just slurping from it directly.
Yeah. And so he's like, look, it's evil is how he described it, and it's because I think he actually understood it, but doesn't like the principles that it represents. Whereas, and maybe some of that rubbed off on Buffett as well. It's hard to say.
Oh, maybe that's reassuring. Maybe it's comforting actually.
Yeah.
Bitcoin mining is obviously a big important part of the network because it guarantees the security of the network and the functioning of the network and the maintenance of the network. All of that is miners. And maybe it would be good to give a bit of a overview about how mining is now, but especially how about the energy. And you said that it's the way Bitcoin fosters the monetization of something that has not been able to be monetized before. It's the energy.
Yeah, so people have a lot of misconceptions around energy, and it's I guess I pay extra attention to it because my background is electrical engineering. So I'm kind of aware of some of the inefficiencies, but basically energy is not fully fungible. If you produce energy somewhere, you can't just teleport it costlessly to somewhere else. And if you transport it too far, it kind of takes up more energy than it took to produce it. So for example, electricity, you can only transport it, several hundred miles or kilometers before eventually the cost of transporting it are too much. And so energy, and also the grid has to constantly balance. So there's fluctuating demand throughout the day and throughout the seasons, and there's fluctuating supply. And that delta has to be either used in some way or it's wasted. So there's literally, orders of magnitude more than the size of the Bitcoin network's energy usage is wasted by grids and by other things every day. For example, the World Bank found that natural gas flaring. So when you drill oil, you get oil out, and if you get a little bit of gas with it, it's not enough gas to build a pipeline or to take the gas. It's just not economic if you're only getting a little bit. So what do? They just burn it. They just light good energy on fire.
And creates pollution as well.
Yeah, it creates pollution. And there's nothing else they can do with it. Now, what Bitcoin miners can do is that if you put Bitcoin miners on site, you can run that natural gas through a generator and power the Bitcoin miners and at least pay yourself a couple cents a kilowatt for that spare energy, and running it through that converts the methane to carbon dioxide more efficiently than burning it. And so it's actually less greenhouse impactful, and you make money from it. And yet World Bank shows that the amount of natural gas flared worldwide per year in terms of energy wasted is something like 8 times the size of Bitcoin's energy consumption.
Wow.
Just that. But then there's also, there's unused hydro. There's tons of unused hydroelectricity that they just, they build this gigantic hydro dam, and it takes time for people to move to that area, or maybe people are not moving to that area. It's just unused power. When China built out a lot of their hydro, that was happening. It happens in Canada. It happens in parts of like northern Norway, for example. There's just unused hydro. And what Bitcoin does, Bitcoin is, unlike a data center, Bitcoin can deal with low bandwidth and low uptime. It can go out to remote regions and just be wherever the energy is. So it's got that kind of flexible aspect to it. And electricity is by far the biggest cost of Bitcoin mining. There's obviously a little bit of hardware costs, there's a little bit of personnel costs, but by far the biggest piece is electricity. So they can go into any region and say, look, we just want your lowest electricity price. And we'll, if you need this to shut off for 2 hours a day, or you need to shut off whenever there's a demand spike or a supply cut, like we'll be the first to cut off because we have the flexibility to do that as long as we price in the lowest electricity when it's available. And so basically what it does is it fills in all the little nooks and crannies and inefficiencies in the system. And, in one given cycle, maybe too many Bitcoin miners go to some place and people complain, oh, look, all these Bitcoin miners. But those, if they stay in a place where there's not energy abundance, then it hurts their cost and they are less competitive than their peers. And so Bitcoin miners will disperse, and they have been dispersing to all the little pockets around where there's unused power. My favorite example is Gridless. There's a company in Gridless in Africa called Gridless, and especially in like the East African region, they go out to like untapped river hydro, and they build little mini hydro dams on little rivers, river hydro, and they mine Bitcoin with it. And in developing countries, there's been a chicken and the egg problem with energy infrastructure. It's really costly to build new power generation and transmission. And, the people there need it, but it's like, how are you going to basically prove that you can put this much cost in and recoup your cost? And yet the people in the area can't develop without electricity. So you have a chicken and egg problem. How do you get started? So one of the ways to do it is you can build a new hydro dam and you can mine Bitcoin with it. That's like your anchor tenant. That's like your guaranteed initial tenant. Even if there's no other paying customers, Bitcoin is a paying customer as long as your electricity is cheap enough. And there's nothing cheaper than stranded energy. So they can build a hydro dam, they can mine Bitcoin with it. And as people in the surrounding area tap into that electricity, they can start to outprice the Bitcoin miners, and they can start to take a larger share of that. And that's what we're seeing. And so you have towns in Africa that were not electrified, that because of a Bitcoin mining new hydro setup, that town now has electricity. And that's a real thing that's happening on the ground.
So genius.
Yeah.
It's so genius. That's what, again, it's one of the things that I didn't even think about it. And then you were mentioning that, and we're talking about this with friends, and afterwards, it's unbelievable. It's literally just chasing for to be wasted or wasted energy, and completing that balance, actually. Yeah,
and it's been remarkable seeing it. So, for example, in 2020, Stone Ridge produced a investor newsletter written by Ross Stevens, their CEO, and he talked about how he sees Bitcoin mining revolutionizing energy over time, and he specifically said African hydro would be like the best place for it. He's like, imagine, rivers in Africa that are all this untapped energy being tapped and basically creating electricity for these people. And at the time, that wasn't really happening yet. And yet, 2-3 years later, Gridless is doing it and increasing their scale of doing it. And there's other companies doing it as well. Another thing he mentioned back then was people right now, people settle around rivers and coasts and basically along transportation networks, and we bring the energy to us. That's how we've always done it. We go out and get the oil, we bring it to us. We go out and get any power source, we bring it to us. Whereas what Bitcoin mining allows you to do is go to where the energy source is, especially things like remote work. If it entices people to move to this river, move to this region, move to this geothermal area. And, during the gold rush in the United States, you'd have people find gold and then a town would sprout up. Someone has to, all those people that are mining, they need haircuts, they need restaurants, they need, they need all these services. And the same thing can happen with Bitcoin mining. You have these like little pockets build up, and people can gravitate toward where there's naturally occurring energy that this can make use of it. And someone has to service the people running it, and someone has to service those people. And you have a little micro town build up and access power. I think basically Bitcoin just fills in all the inefficiencies, and it just takes several cycles to get there. And every time Bitcoin crashes in price and it squeezes out all the miners that have too expensive electricity, over time, only stranded energy makes sense economically.
Yeah, I've talked to a miner, and he said the best time, I asked him, like, when's the best time to start mining? Next bear market.
Yeah.
And he said the gold number in that is 3 years. 3 good years and 1 bad year. And then it purges. So it's actually also just like the economy should be, right? When you have a crisis, a recession, there's nothing bad about that. Just like wildfires, and Sintetib also talked about that. Wildfires are good when they're small scale, they purify things. Yeah. There's like lots of things. When we have fever as well, same thing. We just purge things out. And that's beautiful. And but now I might just go off rail, but the story of mines in the US is a fascinating one. If you look at the beginning of the 20th century, the downside was that it was owned by this mega corporation that would, so to say, enslave like all those people because they owned the houses, the whole economy basically, and they sometimes also had their own money, right? Their own tokens and these kind of things. Yeah. So maybe that should be then definitely not something that if we have like a Bitcoin a village based on mining, that with the Bitcoin virtue, hopefully this would not happen, obviously. That's just in the hands of like the one company that comes there and basically enslaves, so to say, those people living there. Sorry, I'm just totally
I think it's a very there certainly can be bad actors. You know, the larger Bitcoin gets, the more you'll have mostly good actors, but then there's also going to be bad actors. And even back then, mostly things like introducing your own money, it's hard. The reason they're able to do it is because gold and silver are often not divisible and portable enough to fully serve as their own money. So that's why banknotes and things get made on top of them. And basically the company can come in and describe itself as solving a problem, and yet really it's giving people things that they can easily debase. And over time, I think that's going to get harder to do in a Bitcoin world because people can always turn to Bitcoin as a form of money. And the cool thing about these types of areas is that they're mining Bitcoin itself. And some people are getting paid in Bitcoin. Some people choose to get paid in local currency. Yeah. At least so far, the companies that are doing it, I think, are really doing it ethically. But over time, there's always bad actors.
That's a good point.
But I think the main thing is, there's just so much inefficiency. And it's funny, people were really focused on Bitcoin mining energy usage a few years ago. AI is going to blow past Bitcoin mining in terms of size, but it's not as flexible as Bitcoin mining. It can't be offline as much. There's more infrastructure around it compared to power costs. Bitcoin's unique in that it's more flexible and more of its cost is the energy component. And so it can more readily go into all these types of harsher environments and monetize all the stranded energy assets. Yeah,
it's brilliant. And actually, just as you mentioned at the beginning, people were just very negative about it, and the headlines were filled with, it consumes just as much as the Netherlands, or like so on and so forth. And now you have the opposite. You even have now, I think, just recently, I think Alex retweeted something about the World Economic Forum literally shilling Bitcoin mining and how efficient it is. And
it's funny how that works. And I think the next big thing is heat recovery. So Bitcoin mining, it uses electricity and it converts that electricity to heat. That's basically what it does. And we do that for home heaters, for example. We pay for that. Bitcoin mining, the heat is often a negative thing. You don't know what to do with the heat. Now, if you can use the heat for a purpose, I think it was the Netherlands, they were actually heating
I know the company
flowers.
The company that takes the energy out of the heating. Because it blows it over. I think it started actually with data centers, which would create a lot of heat, and it would take that heat and convert it into energy and back into the mining. But you could do also the opposite. You could then heat homes. Just like then, if you have your own mining.
Yeah, there's a hot tub place in New York that heats their hot tubs with Bitcoin miners. There's some of those African ones I mentioned, like they'll dry tea leaves, because you have to dry them pretty quickly. They'll dry them with the heat generated by Bitcoin miners. Marathon is now they're one of the biggest miners in the world. They're now pretty seriously looking into heat recovery. So over time, not only does Bitcoin mining fall into the stranded energy parts, but then also in order to be the most competitive, and it's a very competitive field, you have to eventually figure out a way to use your heat as another revenue stream, drying something, heating something. And so I think we're going to see more and more of that. I mean, there's a company in France that's, competing with heat pumps for heating homes with Bitcoin miners. And that's powerful. And it's funny because I was talking to one of the people from the company, and he's like, it costs, there's more energy spent on heating French homes than the Bitcoin network. So people think of Bitcoin network as a big thing, but it's actually still small in the grand scheme of things. And it can just, all these little energy efficiencies, it can just slip in there and find ways to make use of wasted energy.
Yeah, it's brilliant. Lyn, I think we've reached the end of, literally 2 minutes left. Maybe, okay, let me ask you this, and we'll use this 2 minutes for that. Was there during the conference, based on the people you met, the talks you listened to, or your own thoughts that came up to you, something that you were like, aha?
I think my problem is that I'm in the world a lot, so I often know what people are going to say before they say it. I think one of the most concise ones this time was Jack Dorsey, kind of highlighting the problems that companies face. So basically, small businesses are interesting because the owner owns, the ownership. They own the kind of the ups and downs of the company, and they're not really forced to do anything. But a lot of companies, they take outside capital, and then they kind of lose control of themselves. They become a machine that kind of has to grow. Like you have to go public, or you have to get bought, and you have to keep growing at all costs and making all these trade-offs, and it's no longer in your full control. And so I think he describes that very well because it's something that he went through in a number of his companies, and he's seen that firsthand, and he kind of warns against that now. And that's something I think about because I work in venture capital. It's one of the pieces of work I do. I'm a general partner at Ego Death Capital. We invest in Bitcoin related startups, but we never want to take like an adversarial role or like, hey, you have to grow at all costs. We want to grow sustainably. But there's a lot of venture capital that has that kind of, you start to become more corporate, more the machine. Like we think of corporations doing bad things, but it's often made up of decent people. But they all have an incentive structure that's outside themselves. So the CEO is like, I have to. It's my fiduciary duty to maximize shareholder value. And individual shareholders are like, I wish the company was more ethical, but it's just they're the little pieces of it, right? There's no one really in charge of an organization that broad and that diffused. And so one of the points that Jack made was not everything has to be a company. Maybe there's a handful. Some things have to be companies, but not everything. And so I think, people should be very careful of taking outside capital unnecessarily. And that, not everything has to be growth at all costs, and always pushing away the externalities to someone else. And so that it's never really anyone's responsibility to do things in a kind of ethical way or sustainable way. And I think that kind of encapsulates the fiat system we've lived in for 40, 50 years is really kind of always finding a way to opaquely externalize the cost of something and to keep growing nominally at all costs. I think that kind of sums up not just that narrow area of business formation, but it really kind of summarizes how the fiat currency system operates.
Beautiful. And this was the end. Thanks a lot, Lyn. I appreciate it. This type of conversation is much better than online, but obviously, I hope we get many more opportunities to do that in the years to come. Thanks a lot for your time.
Thank you for having me. Always happy to come on.
Thanks for watching. If you liked this episode, give it a like, and don't forget to subscribe. Leave your actions down below in the comment section. And if you want to watch more videos, feel free to check the most recent video, but also any other video that we've had published on the channel before. See you next time.